The quiet revolution happening right under your nose. My name is Kevin Price, and I want to start today with something that genuinely surprised me when I first encountered it. Not a price chart, not a market prediction, a behavioral pattern, a shift in what ordinary, everyday investors are actually doing with their money right now. Quietly, consistently, and in growing numbers. Average investors are buying gold. Not the ultra-wealthy, not the institutional funds with billion-dollar mandates, not the sophisticated traders with Bloomberg terminals and risk management teams. Ordinary people. People with day jobs and mortgages and retirement accounts and grocery bills. People who 6 or 7 years ago would never have considered gold as part of their financial picture are now actively, deliberately accumulating it. And the question I want to spend this entire video answering is, why? What do they know, or more accurately, what do they feel, that is driving this behavior at a scale we have not seen in a very long time? Let me take you back to a conversation I had with someone I met at a very ordinary gathering. Not a finance conference, not an investment seminar, a casual weekend event among neighbors. And this person, a middle-aged individual with a regular job and a modest but carefully managed financial life, mentioned almost in passing that they had been buying small amounts of gold every month for the past 2 years. Not large amounts, just consistent, deliberate, monthly purchases that were adding up over time to a meaningful position. I asked them why, and their answer has stayed with me because of how unpolished and how honest it was. They said, and I am paraphrasing, "I do not fully understand everything that is happening in the economy, but I understand that the things I need to buy keep costing more. And I understand that the money sitting in my savings account is not keeping up. Gold feels like something real in a world where everything else feels less and less certain." That answer, from someone with no formal financial training, no investment background, and no access to sophisticated analysis, captured something profound. Something that I think explains the behavioral shift we are seeing among average investors more accurately than any chart or data set could. They are not buying gold because they read a research report. They are buying gold because they are living the consequences of a financial system under stress. They are feeling it in their grocery bills, their insurance premiums, their rent, their energy costs. And they are responding to that feeling with the oldest and most instinctive financial behavior in human history, reaching for something real. Something that cannot be printed, diluted, or managed away by a policy decision made in a room they were never invited into. This is the shocking truth behind the title of this video. It is not shocking because average investors are doing something irrational. It is shocking because they are doing something that the conventional financial establishment has spent decades telling them was unnecessary, outdated, and unsophisticated. And they are doing it anyway. Because their lived experience is overriding the official narrative. And their instincts, it turns out, are pointing them in a direction that the data strongly supports. Now, I want to be precise about something before we go further. When I say average investors, I am not being dismissive. I am being specific. I am talking about the broad middle of the investing population. People who are not managing hedge funds or family offices. People who are building financial security through consistent work, careful saving, and thoughtful allocation across a limited set of options. These are the people who historically have been the last to move into an asset class and the first to be told they arrived too late. And right now they are moving into gold in a way that demands serious examination rather than condescension. Because here is what the financial establishment consistently gets wrong about average investors. It assumes their behavior is driven by emotion and therefore unreliable as a signal. But the current move into gold by the broad investing population is not driven by excitement or greed or the fear of missing out on a trend. It is driven by something far more durable and far more significant. It is driven by the direct, personal, daily experience of purchasing power erosion. And purchasing power erosion is not a sentiment. It is a mathematical reality. And when a large enough number of people begin responding to that reality in the same way simultaneously, that response becomes a structural force in the market, rather than a passing trend. Over the course of this video, we are going to unpack this phenomenon from every angle. We are going to look at why gold specifically, rather than other assets, is capturing the attention and the savings of ordinary investors in this environment. We are going to examine the financial mindset shift that is driving this behavior and what it tells us about the broader relationship between ordinary people and the financial system. We are going to look at the common mistakes that average investors make when they first move into gold and how to avoid them. We are going to talk about how to think about gold as part of a broader, long-term wealth-building strategy rather than as a speculative bet or a panic purchase. And we are going to close with a clear, honest warning about what this mass behavioral shift toward gold might be signaling about where the financial system is heading and what that means for anyone who is not yet paying attention. This is going to be one of the most grounded and I hope genuinely useful conversations we have had on this channel. Because it is not about sophisticated investors doing sophisticated things. It is about ordinary people making a very important financial decision. And understanding why they are making it might be the most valuable thing you take away from anything I share with you today. The financial mindset shift nobody taught you. There is a question that sits at the heart of everything we are discussing today. And it is a question that most people have never been directly asked by anyone in their financial lives. The question is this: what is money actually for? Not how does money work, not how do you make more of it, but what is it fundamentally for? What job is it supposed to do in your life? Most people, if they are honest, have never thought about that question carefully. They have thought about how to earn money, how to save it, how to invest it, how to spend it wisely. But the deeper question of what money is actually supposed to accomplish, what fundamental problem it is designed to solve, that question gets very little airtime in conventional financial education. And the answer to that question is the foundation of why average investors are moving toward gold right now. Because they are beginning, consciously or not, to distinguish between two very different jobs that money is supposed to do. And they are realizing that the instrument they have been using for both jobs is only reliably doing one of them. The first job of money is to facilitate transactions, to be a medium of exchange that allows you to trade your labor and your time for the goods and services you need. The dollar does this job reasonably well. It is widely accepted, easily transferred, and practically convenient for everyday transactions. The second job of money is to store value, to be a reliable vessel that holds the purchasing power you have accumulated through your work and your discipline across time. To ensure that the sacrifice you made today, the hour of labor, the deferred consumption, the careful saving, retains its real value into the future, so that you can use it when you need it most. And this second job, storing value reliably across time, is the job that the dollar has been failing at with increasing severity. Not dramatically, not in a way that makes headlines every morning, but consistently, quietly, and with an acceleration that the lived experience of ordinary people is registering even when the official statistics try to soften the picture. This is the mindset shift that is driving average investors toward gold. They are separating these two jobs in their thinking. They are keeping enough dollars to handle the transaction job, to pay bills and meet obligations and manage daily life. But for the store of value job, for the portion of their wealth that they are trying to preserve across time, they are increasingly reaching for something that has a 5,000-year track record of doing exactly that. Gold does not pay a dividend. Gold does not generate earnings. Gold does not grow a business or innovate a product. Gold does exactly one thing. It holds value across time with a reliability that no paper currency in human history has ever matched. Every single paper currency that has ever existed has eventually lost significant purchasing power or ceased to exist entirely. Gold has never gone to zero. It has never been inflated away. It has never been defaulted on. And that singular, unbroken track record is precisely what ordinary investors are reaching for when the currency in their savings account starts feeling less reliable. Now here is the mindset mistake I want to address directly. Because there is a version of this shift toward gold that is healthy and a version that is not. The healthy version is deliberate, proportionate, and grounded in a genuine understanding of what gold is and what role it plays in a balanced, long-term financial picture. The unhealthy version is reactive, emotionally driven, and disproportionate. It is the version where someone gets frightened by what they see happening around them economically and suddenly wants to put everything into gold because it feels safer than everything else. That second version creates its own serious problems. Gold is a long-term store of value. It is not a short-term trading instrument. It is not a get-rich-quick vehicle. And it is not a complete financial strategy on its own. The people who move into gold with the right mindset treat it as one important component of a broader financial picture, a foundation of real value that anchors the rest of their portfolio against the specific risk of currency debasement and purchasing power erosion. The people who move into gold with the wrong mindset treat it as a refuge from all financial risk simultaneously. And when gold goes through one of its inevitable periods of consolidation or correction, because it does, regularly, they panic and sell at exactly the wrong moment. Not because gold failed them, but because their expectations were wrong from the beginning. Understanding what gold is, what it does not do, and where it belongs in a realistic financial strategy is the mindset foundation that every average investor needs before they make their first purchase. And that understanding is what separates the investors who build real, long-term value from this asset, from the ones who buy high on fear and sell low on disappointment. The shift happening among average investors right now is significant. It is real. And it is grounded in a genuine and correct instinct about the store of value problem. The question is whether the people making this shift are doing it with the right framework or the wrong one. And building that right framework is exactly what the rest of this video is designed to do. The mistakes average investors make when they buy gold. Getting the thesis right is only half the battle. The other half is execution. And in my experience watching ordinary investors move into gold, the execution mistakes are just as costly as having no position at all. So, let us talk about the most common ones clearly and directly. The first mistake is buying at the peak of fear. There is a very predictable cycle that plays out with gold repeatedly. The financial news gets scary. Inflation numbers come in hot. A geopolitical event rattles the markets. And suddenly, gold is on every channel, in every headline, and in every conversation. And that is precisely the moment when the largest wave of average investors rushes in, buying not because of a considered long-term decision, but because the anxiety of the moment made staying on the sideline feel impossible. The problem with buying at the peak of fear is that fear peaks are often price peaks. The smart money that understood the thesis months or years earlier is already positioned. They are not buying at that moment. They are quietly watching the crowd arrive, and in some cases beginning to take partial profits. The average investor who buys into that moment of maximum anxiety often buys at or near a local top, and then experiences the correction that follows with a position they do not have the conviction to hold through. The solution is not to avoid gold when the news is scary. The solution is to build your position before the news gets scary. Gradually, deliberately, and based on the fundamental thesis rather than the emotional temperature of the moment. The second mistake is confusing paper gold with physical gold without understanding the difference in risk. ETFs, futures contracts, and gold certificates are all convenient ways to gain price exposure to gold, but they carry counterparty risk that physical gold does not. You are not owning gold. You are owning a financial instrument whose value is supposed to track gold. In normal market conditions, that distinction barely matters. In a genuine financial stress scenario, that distinction can matter enormously. Average investors need to understand what they actually own and why before they decide which form of gold exposure is appropriate for their situation. The third mistake is neglecting to think about storage and security for physical gold. Physical gold that is improperly stored, inadequately insured, or carelessly disclosed creates risks that offset a significant portion of its value as a safe haven asset. This is a practical consideration that gets very little attention in the excitement of the purchase decision, but deserves serious thought before rather than after. The fourth mistake is checking the gold price every single day and letting short-term fluctuations drive emotional responses to a long-term position. Gold can be flat or down for extended periods, while its fundamental thesis remains completely intact. If you are measuring a 5 to 10-year store of value decision against daily price movements, you are applying the wrong time frame to the right asset and setting yourself up for unnecessary anxiety and poor decisions. Build the position thoughtfully. Understand what you own, store it properly, and then give it the time horizon it deserves. How to think about gold in a real long-term portfolio. Gold belongs in a portfolio the way a foundation belongs in a building. You do not live in the foundation. You do not show it off to guests. But without it, everything built above it is vulnerable in ways that are not visible until the ground shifts. That analogy captures exactly how I think about gold in a serious long-term financial strategy. It is not the exciting part of your portfolio. It is not the part that generates the stories you tell at social gatherings. It is the part that quietly, consistently, does the one job that everything else in your portfolio cannot reliably do. It protects the real purchasing power of what you have accumulated against the specific risk of currency debasement. So how much gold is the right amount? This is the question I get asked most often, and I want to answer it honestly, rather than with a number that feels authoritative, but ignores the reality that every person's financial situation is different. What I can give you is a framework for thinking about it. The starting point is understanding your exposure to dollar-denominated assets. Most average investors are overwhelmingly concentrated in dollar-denominated instruments. Stocks priced in dollars, bonds denominated in dollars, savings accounts holding dollars, retirement accounts invested in dollar-denominated funds. All of these assets share a common vulnerability. They are all subject to the purchasing power risk of the dollar itself. If the dollar loses significant real value over your investment horizon, all of these assets lose real value simultaneously, regardless of their nominal performance. Gold is not dollar-denominated in the same way. Its value is determined by the global market for a scarce physical asset with thousands of years of monetary history. It moves independently of dollar policy decisions, and that independence is its primary value in a portfolio context. Not as a return generator, but as a diversifier against the specific risk that everything else you own shares. Given that framework, the appropriate allocation to gold is whatever percentage of your portfolio you need it to be to genuinely offset your dollar concentration risk in a way that you can hold comfortably through volatility without it destabilizing your overall financial picture. For most average investors, that tends to fall somewhere between 5 and 15% of total investable assets. Meaningful enough to matter, not so large that gold's volatility creates instability in everything else. The second thing I want you to think about is the relationship between gold and your time horizon. Gold rewards patience. It is not an asset that performs linearly or predictably in the short term. Over long periods, measured in decades rather than years, its track record of preserving purchasing power against currency debasement is exceptional. Over short periods, it can be frustrating, volatile, and seemingly disconnected from the fundamental thesis that makes it compelling. Matching your time horizon to the asset's nature is not optional. It is the foundational requirement for getting value from a gold position. If you need the money in 2 years, gold is the wrong place for it. If you are building wealth over a 10 to 20-year horizon and want a portion of that wealth to be genuinely protected against the currency risk that all your other assets share, gold earns its place in that picture clearly and compellingly. The third element of thinking about gold in a real portfolio is understanding how it interacts with your other assets. Gold tends to perform well when stocks and bonds are under stress from inflationary or currency pressures. That negative correlation, the tendency to move in the opposite direction from conventional assets during the specific scenarios where conventional assets are most vulnerable, is what makes it genuinely valuable as a portfolio component, rather than just as a standalone investment. It is not about gold versus stocks or gold versus bonds. It is about gold alongside those assets providing a layer of protection that they cannot provide for each other. That is the sophisticated way to think about it, and it is available to every average investor, regardless of the size of their portfolio. Shocking. Why average investors buy more gold, Part 5 of 5, the final warning, and what this moment is really telling you. We have covered a great deal of ground together today. We started with a behavioral observation that is more significant than it first appears. Ordinary, average investors are buying gold in growing numbers, not because someone told them to, not because it is trendy, but because their lived experience of a financial system under stress is driving them toward the oldest and most reliable store of value in human history. We talked about the mindset shift underneath that behavior, the growing separation in ordinary people's thinking between money as a transaction tool and money as a store of value, and the quiet but powerful realization that the dollar, while still functional for transactions, is increasingly unreliable for the second job, the job of preserving what you have worked hard to accumulate across time. We talked about the mistakes that derail average investors when they first move into gold. Buying at the peak of fear, misunderstanding the difference between paper and physical gold, neglecting storage and security, and applying short-term thinking to a fundamentally long-term asset. And we talked about how to think about gold correctly within a real, balanced, long-term portfolio, as a foundation, as a diversifier against the specific currency risk that all dollar-denominated assets share, as a patient, quiet protector of purchasing power that rewards the investors who understand its nature and give it the time horizon it deserves. Now I want to close with something that ties all of that together into a single, clear, honest picture of what this moment is actually telling us. The fact that average investors are moving toward gold in significant and growing numbers is not just interesting data about consumer behavior. It is a signal, a deep, structural signal about the relationship between ordinary people and the financial system they live within. When the broad middle of the investing population, people with no financial training and no access to sophisticated analysis, begin independently reaching the same conclusion about the need to hold real assets outside the paper currency system, that convergence of instinct is telling you something important. It is telling you that the confidence gap between what the official financial narrative says and what ordinary people are actually experiencing in their daily financial lives is widening. And historically, when that gap widens far enough, the market eventually closes it. Not gently, not gradually, but in the kind of sharp, structural repricing that rewards those who were already positioned and leaves those who were waiting for confirmation arriving too late to capture the real value. The average investors buying gold right now are not sophisticated. They are not working from complex models or detailed analysis, but they are responding to a real signal with a real and historically validated response. And the investors who dismiss that behavior as unsophisticated, who wait for institutional validation or mainstream consensus before taking the same step, are making the classic mistake of confusing sophistication with correctness. Sometimes the most important financial truth is the simplest one. Things that are real hold their value. Things that can be printed without limit eventually lose it. And when enough ordinary people begin acting on that simple truth simultaneously, the financial system has to respond. That response may already be beginning. The price of gold is not where it is by accident. It is where it is because a growing number of people, from average investors buying small amounts monthly to central banks accumulating at record levels, are reaching the same conclusion from different directions at the same time. And that convergence, when it reaches a critical mass, produces the kind of sustained, structural move that defines a generation of wealth building for those who were positioned early and disciplined enough to hold. Do not be the person who watches that move from the sideline. Do not be the person who understood the thesis, agreed with the reasoning, felt the urgency, and then waited for one more confirmation that never came in the form they expected. The confirmation is already here. It is in the behavior of the average investors we talked about at the very beginning of this video. It is in the supply data. It is in the debt levels. It is in the purchasing power numbers that ordinary people are feeling every single day in every single transaction they make. The question is not whether gold deserves a place in your financial picture. The question is whether you are going to act on that answer before or after the window of current prices closes permanently. I am Kevin Price, and I want to say something genuine to you before we close today. Building real, lasting financial security in this environment is not easy. It requires thinking differently from the mainstream. It requires patience when everything around you is moving fast. It requires the courage to act on what the evidence is telling you before the crowd catches up. And it requires the discipline to hold what you have built through the inevitable volatility that comes before the destination. But it is possible for anyone, at any level of wealth, with any size of portfolio. The principles do not change based on the number of zeros in your account. And every video on this channel is built on the commitment to give you those principles as clearly, as honestly, and as practically as I possibly can. If today's conversation gave you genuine value, if it shifted something in how you think about gold, about money, about your own financial position in this environment, please take one moment right now and hit that like button. It is the simplest and most powerful way to tell me that this kind of serious, in-depth, no-hype financial education is worth continuing. And it helps this message reach the people who need it most. If you are not yet part of this community, please subscribe to this channel today and turn on the notification bell. Every video I create is built on the same foundation as this one: real thinking, real education, real respect for your intelligence and your time. No shortcuts, no empty promises, no excitement without substance. And please drop your thoughts, your questions, and your own experiences in the comments section below. Tell me where you are in your own gold journey. Tell me what questions this video raised that you want to go deeper on. Tell me what you agree with and what you want to push back on. I read every comment. I respond as personally as I can. And this community, the conversation that happens in those comments, is one of the most valuable things about what we are building here together.